Stock prices can change in seconds. Housing prices rarely do. The same economic event can trigger immediate volatility in financial markets, while real estate appears stable, even quiet. That contrast is not accidental, it is structural. When interest rates shift or economic data surprises the market, financial assets reprice almost instantly. Investors watch screens update in real time. Gains and losses appear immediately. Housing markets operate differently. Even during periods of significant economic change, real estate tends to move gradually. Transactions slow, listings linger, prices adjust over extended periods. This difference leads many to assume housing is simply delayed. In reality, housing follows a different adjustment mechanism altogether. Liquidity determines how quickly markets process new information. Stock markets are highly liquid. Millions of shares trade daily. Buyers and sellers connect instantly through centralized exchanges. Orders are matched automatically. Market depth allows price to adjust in real time. Housing lacks that structure. A property may transact once every several years. There is no centralized exchange with continuous bids and offers. Each transaction is individualized, negotiated, spaced out over time. When liquidity is limited, price discovery slows. Instead of immediate repricing, activity declines. Fewer transactions occur. Markets pause rather than pivot. Liquidity is the primary reason financial markets move quickly, and housing markets do not. Financial assets can be bought or sold with minimal effort. Transaction costs are low. Settlement is efficient. Real estate transactions involve inspections, appraisals, financing approvals, title review, legal documentation, closing procedures. Costs include commissions, fees, taxes. The process can take weeks or months. High transaction friction discourages rapid turnover. Participants consider decisions carefully because reversing them is costly. This friction dampens volatility but lengthens adjustment cycles. When it is expensive and time-consuming to transact, markets do not move quickly. In financial markets, prices are transparent. Participants see bids and offers instantly. Assets are marked to market continuously. The most recent trade sets a visible reference point for everyone. Housing relies on comparable sales. Those comparable sales reflect transactions that occurred in the past. Each property is unique. Pricing is negotiated privately. There is no centralized clearing mechanism, establishing a universal, real-time price. This difference in price visibility shapes behavior. In financial markets, participants react to immediate signals. Momentum builds quickly because everyone sees the same information at the same time. In housing, signals are slower and less precise. Buyers and sellers rely on recent sales data, which may already lag current economic conditions. As a result, expectations adjust gradually. Participants wait, they observe, they compare, they hesitate, because housing prices are discovered through periodic transactions rather than continuous trading. Visible repricing unfolds gradually. This structural difference explains why housing markets respond slowly. Even when economic conditions change rapidly, that slower adjustment process also changes risk perception. In financial markets, volatility is visible instantly. Losses are marked to market in real time. In housing, risk often appears muted because pricing does not update continuously. But that does not mean risk is absent. It simply means it surfaces differently through transaction volume, time on market, and negotiation dynamics. Those indicators move first. Prices follow. And that lag is not weakness. It is design. Investor behavior differs across markets. Stock market participants often manage portfolios actively. Positions are evaluated daily. Performance is visible and measurable in real time. In some cases, leverage or margin requirements create pressure to sell when prices decline. Homeowners are typically long-term holders. Many occupy the property. They are not required to mark their asset to market daily. If demand weakens, they can delay selling, rather than accept a lower price. This creates a second-order effect. In financial markets, falling prices can generate additional selling pressure. In housing, weakening demand often reduces listing activity instead. Supply withdraws rather than expands. That behavioral difference slows downward price movement. When financial markets adjust, price moves first. Volume follows. In housing, volume moves first. Price follows. Transaction counts decline. Days on market extend. Negotiations increase. Seller concessions appear. Prices may flatten before they decline. Housing frequently corrects sideways. Time absorbs imbalance. Over extended periods, supply and demand gradually realign. The slower adjustment does not imply immunity from economic forces. It reflects structural design, illiquidity, friction, delayed information, participant incentives. Combined, they create gradual cycles rather than sudden swings. For owners, stable prices do not guarantee liquidity. In slower markets, properties may take longer to sell, even if values appear unchanged. For renters, financial market volatility does not translate into immediate housing price shifts. Affordability changes more gradually. For investors, real estate introduces duration risk. Capital is less flexible. Lower apparent volatility often corresponds with higher liquidity risk. For the broader market, housing cycles unfold over extended time horizons. Rapid movements in financial markets should not be interpreted as immediate signals of housing repricing. Housing markets move slower than stock markets. Because they are built differently, liquidity is limited. Transactions are costly. Price discovery is delayed. Incentives discourage rapid turnover. Time becomes the adjustment mechanism. Understanding these structural differences prevents misinterpretation of market signals. Markets rarely move in isolation. Financial volatility can influence sentiment. Sentiment can influence housing demand. But structural differences determine how those influences are expressed. Rapid changes in equity markets may alter confidence quickly. Housing absorbs those shifts over time through slower negotiations, extended marketing periods, and gradual pricing adjustments. Recognizing this distinction allows investors to respond with discipline rather than urgency. The speed of one market does not dictate the speed of another. Structure determines timing. Subscribe for market insights. Link in description for additional analysis.